This week, Ginnie Mae extends the LIBOR deadline for HECM mortgage-backed securities and negative interest rates. Stand by for details.
Click on the banner above to learn more about our sponsor, Fairway Independent Mortgage.
Welcome back, and thank you for joining us. This week, I'm going to review two of the most recent impactful news developments. Those are Ginnie Mae's extension for LIBOR-indexed loans and also more central banks now moving into negative interest rate territory, and what that could mean for our industry should we find ourselves with the same. Negative interest rates? Yes, you heard that correctly, and no, you do not have to turn up the volume on your computer. In fact, negative interest rates are here in the U.S. already. While you most likely will not see that economic anomaly mentioned in your local or national evening broadcast, financial outlets have assiduously reported on the central banks around the globe who are now pulling out all the stops and using their largest ammunition in the effort to stimulate the economy in the wake of the COVID-19 pandemic.
That's why Harvard professor of economics Ken Rogoff believes negative rates will eventually make their way to the United States.
Eventually it will come here to the United States. It may happen sooner rather than later.
The European central banks, Sweden and Germany, currently are in negative interest rate territory, and the U.S. may follow, whether by choice or global pressure. Does that mean that the banks are going to pay you to borrow money? Not necessarily. Negative interest rates actually penalize the bank for hoarding cash reserves instead of lending to the consumer and businesses and earning interest income. It's usually an economic tool and a rare one at that. So closer to home, how could that impact reverse mortgage industry and the homeowner? Savers, first of all, or older retirees are going to feel the impacts immediately because they're going to be unable to count on really any interest earnings to help offset inflation. That conceivably could increase demand for alternative sources of cash flow, such as a reverse mortgage. Last Monday, the one-year U.S. constant maturity treasury rate was just 0.1%. The one-month LIBOR index was a mere 0.157%, and the SOFR, the secured overnight finance rate, was just 0.09%. Let's assume that the base index for the federally insured reverse mortgage fell below 0%. Now, what impacts would the existing borrowers see? First, their principal limit, or the line of credit growth rate, as we like to call it, would slow significantly, but not altogether, thanks to the lender's margin in the loan. And that's something you should keep in mind when you're touting the benefits of the future borrowing power of the HECM with the financial professional and the homeowner. Next, future home equity is going to be consumed at a much slower rate, as the loan balance will be growing more slowly with negative amortization than it would in a normal interest rate environment. Lastly, with the average lender margin hovering around 2% today, new HECM borrowers will benefit by being in the lowest interest rate tier of the HECM principal limit factor tables, in fact, bumping against the present 3% interest rate floor. While the word unprecedented has become increasingly popular in the wake of the COVID-19 pandemic, the truth is negative interest rates have been employed on a few occasions. And speaking of rates, Ginnie Mae, the issuer of HECM mortgage-backed securities, recently provided a reprieve of sorts. It was just in September that our industry found itself somewhat caught off guard on our heels when Ginnie Mae announced that the HECM mortgage-backed securities, which are tied to the LIBOR index, would no longer be accepted for any MBS pools received on or after January 1st, 2021. Didn't leave us much time. Now, that news did come as a surprise since NORMLA was in active discussions with Ginnie Mae, HUD, and others on what the replacement index would be for future HECM loans that were securitized. The good news is that the deadline has been extended to March 1st. As RMD reports, Ginnie Mae did contact the reverse mortgage industry, the members of which provided us with additional feedback relating to the volume of applications received by the initial publication date. That said a Ginnie Mae spokesperson to RMD. So chime in with your thoughts on these stories by leaving your comment. And don't forget, today and every Monday, we release a new podcast episode so you can listen and get your reverse mortgage news on the go wherever your day may take you. Thank you for joining us, and be sure to return next week for more reverse mortgage news, commentary, and analysis here at HECM World. And have a very happy and safe and Merry Christmas. We'll see you soon.